Friday's non-farm payrolls are expected to provide further evidence that the U.S. recovery is strengthening. Earlier this week, the ADP Employer Survey report showed companies added 201 workers in March. That brought the average monthly increase in employment over the last 4 months to 211,000. That is almost 3 times the average monthly gain of 74,000 over the preceding 4-month period. And on Thursday, initial jobless claims came in a little higher than estimated, but still showed a fall from the previous week. Well, let's get more on the U.S. jobs report with Hans Goetti. He's Chief Investment Officer at Finaport Investment, and he joins us from Singapore. Good to see you, Hans. So we have, it looks like, another decent number coming out of the jobs report here, but other economic data has been softening. What does it all mean for Fed policy?
Well, what it means is that the Fed will probably have to consider adding to liquidity after QE2 expires. The problem there is that there is a lot of opposition to expand the balance sheet of the Fed any further. You have opposition within the Fed, you have opposition in Congress, and you probably have foreign holders of Treasury who will not be exactly delighted if the Fed continues to debase the dollar even more. And our reading is this: QE2 will probably expire. But if the economy shows renewed weakness until then, and there's an emergency coming up, a crisis, maybe the stock market drops or something, that could give the Fed the cover to continue adding to its balance sheet. It may not be called QE3, may be called somebody else, but something else. But we think it's inevitable at the end of the day, unless the economy stages a very, very strong recovery between now and then.
Q3 is inevitable. That's a pretty strong statement, especially when we have people like the Fed of Minneapolis, the president of the Minneapolis Fed, saying that the Fed may have to raise rates to fight inflation.
Right. It is very hard to see how the Fed can raise rates. I mean, first of all, higher interest rates will put a lot of burden on the government. The interest payments are going through the roof because the deficit is $1.5 trillion every year. If you add 1% to the interest rate burden, that's 140 billion right there. You know, so we think that interest rates will probably not go up by a lot, at least for the next 12 to 15 or to 18 months, and that the Fed is pretty much locked into this near zero interest rate policy.
What happens to financial markets if and when QE2 does expire? There's even been talk of letting that expire even earlier. Is that, you say that may be the crisis that the Fed uses to then launch QE3. Is it going to be a shock, do you think?
Well, it's very hard to tell what the catalyst will be, but it is what we are seeing is an economy that is still not self-sustained. I mean, we have, again, renewed weakness in certain areas. We have a housing market that has not recovered. It's actually deteriorated as of late, and the housing market is very important. We have gasoline prices going up. We have cutbacks at the state and local government level. These are all headwinds for the economy, and to raise interest rates into an environment like this, or even discontinue further liquidity injections would be a dangerous strategy. So what we could see is maybe a pullback in the equity market, maybe a marked deterioration in the labor market again by the middle of the year, and that will give the Fed the cover. So we'll see what happens, but we think QE3 eventually will be a reality.
Hans Goetti of Finaport Investment Intelligence, thanks very much for being with us.